the good news is obviously that you have some segments of the economy that are humming along. You have credit conditions which are decent, employment which is fine. All those feed into a consumption growth number which is fine. However, I think what we're doing is essentially the escalation in the trade war creates a lot of uncertainty about how that feeds back into the future growth of the U.S. economy. It's hard to really say at this point, and so I think that volatility could push us over the edge for a recession. We've escalated our own evaluation of what recession risk is going to be over the next 12 months. And I think you're subject to the vagaries of the negotiations and how those play out.
That recession probability, what is it now?
So I think if you're building up, we'd say if you looked at the economy today, you'd say it's about 15 or 20%. Really good, actually, in the context of an expansion which is this long. But once you layer on to the fact that we're, in a sense, weaponizing uncertainty against the outlook, you have to add an adjustment factor to that. I'd put it up to 40% once you add that in.
So, Ben, you're looking at increasing odds of recession, slowing growth, and we haven't really talked about EPS growth, but it's, corporate earnings have been largely disappointing in 2019 at low single digits. Where do you position a portfolio given those three factors?
Yes, I think, if you want to take risk or not, I think is question number one. We position based on the outlook and the follow-through into EPS fundamentals. We're slightly underweight equities at the moment, right? So we're positioned moderately cautiously in our portfolio. In our portfolios, we're picking our spots in credit. We're sort of up in quality in credit. We're thinking about what is your insurance policy against downside risks of the outlook and negative growth shocks. So treasuries have traditionally played that role. It's hard to make a big case to buy treasuries at these levels. But the truth is they're reflecting a real phenomenon underneath it, elevated recession risk and elevated uncertainty. And so I think you have to have a slightly cautious tilt in your portfolio writ large and be agile as things unfold.
When was the last time you were underweight equities?
It's been a little while.
Since when? The financial crisis or 2011?
No, I think selectively 2015-16 was the last time we were in any size underweight equities. But it all goes back to that recession risk, right? And as an economist, I'm slightly biased here that that's a really important fundamental. But the pro-cyclicality of risk assets means that's the fundamental. So if you get one thing right over the course of the cycle as a multi-asset investor, it's what is the proximity to that adverse place for risky assets, and also on the other side, when are you getting out of it? And so it's elevated, and hence we're
I'm curious, when you upped
your
your outlook for recession, was it precipitated by the inversion of the yield curve? And what do you make of all these forecasts that, even after inversion, stocks have X number of months? Joe says it's 6 months. Other people say it's, 18 months for stocks to do well. Because you're underweight here, and the risk is missing out on that
and
outperformance.
40% is still more likely there's not a recession. And if the trade stuff were to be settled, you go back. You said 20% is the baseline, right. So you're going to miss out. Yeah, it's more important to prepare for the possibility of loss.
So even if you think that the trade issue is going away, right, which is a pretty bold assertion at the moment. Even if that's the case, I think you have to look at the asymmetry of outcomes, right? So your downside case, which you put 40% risk probability on, is that equities are down the usual recession 20 or 30%. Your upside case, what is that in an environment where you expect EPS growth to be 5% in 2020? Consensus is 10%. And so, a lot of the good news, to the extent there is any, is in there already.
If you don't lose 20%, it's like you just made 30, I think, isn't it?
Yeah, so there's going to be some volatility as things play out with the trade volatility. But if anything, taking a longer run perspective, that's just decreasing the Sharpe ratio of equities as an asset class. So all things equal, if you expect that volatility to persist, you're just holding fewer equities at the moment.